probably your iPhone with a Luxor in the background. And you talked about how this is changing capital markets, changing inflation, and the whole like structure of the economy. Can you elaborate on tell the listeners what you think about that?
Yeah, sure. So historically, capital and demographics have not been intertwined. Now, yes, as you age, your net worth increases. And as you age, you become more adventurous with your investments, and that drives more economic activity. And then when you retire, you cash it all and go to T-bills because you won't be able to stomach any sort of market turning or currency turning. That's been true since the dawn of recorded history. There's nothing new there. What is new is the demographic profile has changed. So in a pre-industrial world, you had very few 60-somethings. You had more 50-somethings and yet more 40-somethings and on down. It built a pyramid. What industrialization and urbanization has done is change the shape of the pyramid. In some countries like the United States, it's more or less a chimney, but with a bulge for the baby boomers. In some like Germany, it's a diamond with more people in their 50s than their 40s than their 30s than their 20s, and then narrowing up as you would expect at the top. What's happening globally right now, not just with the American boomers, is that we've got this big cadre of people in their 60s who are moving into retirement, and they are a bulge in the structure. So instead of just a small group of people relative to the overpopulation that are moving on and changing their investment portfolios, we have the single largest generation in our history doing that. And on average, they will have completed that transition by the end of this year. So we go from having some of the richest, most liberal, most open, most liquid capital markets we've ever known to something that's a lot closer to the opposite in less than a year.
But, with our financial repression that we've been going through for many years, I mean, this system has pushed people way farther out onto the risk curve in terms of their financial lives. You can't be 70, 75 years old investing in bonds or T-bills anymore, right? It just doesn't work. So you see these older people doing things that they shouldn't be doing financially. They shouldn't have to do, I'll put it that way. But they've got to earn some yield, and
And the first time you have a market turning, they become destitute. That's why most people don't do that. I agree that there's a percentage of people that are, and that is unfortunate. And we're about to learn that good and hard, because we're not just having this demographic turning, we're of course at the market tightening at the same time, and that's just damnably inconvenient.
But make sure we understand the link between inflation, capital availability, and the demographic situation. So baby boomers are retiring quickly. I mean, most of them are almost through the pipe. I don't know. I haven't looked lately, but
the midpoint is the end of this year.
Say that again?
The midpoint is the end of this year.
Okay, so the midpoint of the baby boomers is the end of this year now, and then it trails off. And I don't know the stats, but something like 10,000 a day retire, or some number like that, or whatever.
It's some ridiculous number.
It's big, yeah.
Yeah, I mean, the problem here is we're losing the single largest worker cadre we've ever had, and the replacement generation down at the bottom of that pyramid, the Zoomers, they are the smallest generation we have ever had.
I'm sort of wondering why you identified, and you did that in the book, why you identified the Zoomers and you didn't say just the next one down, which is my cohort, which I think might be yours too, which is Gen X.
Well, Gen X and millennials have been in the labor market already. So we're already factored into the math. Now, there's pros and there's cons, and that shapes a lot of things, but we are already in. The Zoomers are the ones who are coming in to replace the boomers. And we have our largest generation going out, our smallest generation coming in. So right now, annually, that's 400,000 worker shortage. And that will increase every year until 2034, when it'll peak at 900,000 shortage. And these people are already born, they're already on the way. We know exactly what's going to happen to the net flows each and every year moving forward. Yeah, there's no mystery about this, which is what I love about studying demography. And Harry Dent got me into that in the 90s, and ever since I've been a real, student of that idea, even though some of his predictions have been a little off. So he's been on the show 11 times, and every time there's a bubble, but this time he's going to be right. I think we'll see. But what that does, what you just said, is that gives the bargaining power to the labor, not the capital, right? The problem is that capital is going away at the same time. I certainly agree that the relationships are going to change. I think it's a little bit arrogant to think that I know exactly how. But we're definitely entering a period of protracted and extended and increasing labor shortage. At the same time, we're entering into a period of protracted and extended and increasing capital shortage.
Okay.
And just to make it a little bit more fun, China's collapsing against this backdrop. So even if we decided we were fine with a completely globalized supply chain, we still need to double the size of the industrial plant in the next few years with less capital and with less labor.
Okay, so less labor would be inflationary because that would push wages up generally.
I would argue that at the moment, the labor disconnect is the single largest issue behind our inflation numbers right now.
Okay, but tell me about less capital. I mean, I'm coming at it from kind of this angle that, capital doesn't really disappear. It changes hands and, you could argue it changes places, right? It might be in more, risk on investments like the stock market, or it might be risk off like bonds or, money markets, right? So what do you mean that the capital is drying up? Like, how explain that a little more?
Well, the baby boomers are at the height of their earning experience. And as of the end of this year, they won't be earning anymore. So the net inflows into the system from just normal demographic structure dry up considerably. The next generation down, Gen X, is very small. And even if we do succeed in having significant raises now in this labor inflationary environment, there aren't enough of us to generate nearly as much in total. So step one, we're losing volume. Step two, we're losing investment quality because in the flight from risk on to risk off, the capital becomes a lot less interesting. Sure, this is going to be broadly decent for people who want to be in the government and borrow because that's the T-bill. That's considered the ultimate gold standard. And to a degree, that helps with the mortgage market as well, because mortgage rates primarily draw their guidance from the 10-year as opposed to interest rate levels. After that, though, you're entirely dependent on capital flight from the rest of the world. Now, I think that'll be robust, but I also think that'll be wildly inconsistent depending on what's going on in the United States versus wherever else the capital might be. This is still the deepest, most liquid market in the world. It's denominated in the sole source of global store of value. It is the only meaningful method of exchange for international transport and trade. And the Japanese and the Europeans have basically signed on to a US dollar denominated system as part of the deal that generated the sanctions against the Russian central bank a couple of months ago. So if you're going to benefit from this in any way, the US dollar is the place to be, but you can't predict the inflows year on year of what's coming in from the European space or the Asian space. It will come when they're in trouble and we look good, and it will probably never go back. And so we know that the capital supply has to drop domestically, and we know we're going to get these bursts of capital from abroad. But planning on that, that takes a smarter brain than I have.
So 15 years away, though, that capital starts to pass from baby boomers to millennials.
Yes.
What happens?
And the millennials themselves will then be entering their late stage worker years. Well, they will gradually become the dominant capital providing class again. So for the United States,